I am insurance poor. You've heard that one, right? Well, it's what someone says when they feel like grousing about all the insurance premiums they pay. The clear implication is that the payment of the premiums is somehow causing poverty. Actually, it's the other way around. The payment of your insurance premiums is what keeps you out of poverty. But you're going to have to think about it a minute to get my point. The $1,000 a year that someone pays to the insurance company to protect their $250,000 house is not going to cause poverty. Yes, I'd love to have the grand back in my pocket, but having to pay it is not going to break me. But what will break me is having the grand back in my pocket because I refuse to carry insurance on my house and then my house burns down. Now I've got the $1,000, but I am $250,000 poorer. That's going to come very much closer to causing poverty than my payment of a premium. But you also need to know the difference between if insurance and when insurance. If insurance is the most common kind. It's designed to protect you against the negative financial consequences of an unlikely catastrophic event. When the possibility may be remote, your house might burn down. You might have a car wreck. You might need brain surgery, or you might become disabled, or you might get sued. Any one of these events could cause severe enough financial consequences to bankrupt you. So you incur a guaranteed small loss, called a premium, to avoid a potential catastrophic loss. That's if insurance. When insurance is different. It offers a different kind of risk management. When insurance deals with events in your life that will occur, it's just that no one knows exactly when. Take retirement, for example. A pension plan knows its covered retirees will retire. They just don't know how long each one is going to live. So when calculating the reserves required to fund the retirement pool, retirement plan actuaries are able to average together a large number of people. They call this the law of large numbers. The actuary can't tell which of the retirees will only collect a few retirement checks because they die early, but they can predict with great accuracy how many will die early out of a large pool of people and how many will live an extraordinarily long period of time. It's okay to think of if insurance as an expense. It is a sure small loss incurred to avoid a potentially disastrous large one, therefore helping you avoid poverty. But you should also think of when insurance not so much as an expense, but as funding, a somewhat larger cash flow that pre-funds an even larger amount of money that will come back to you in the future, either through retirement payments or living benefits or some kind of cash value or even a death benefit. Its predictability and guaranteed continuity also help you avoid poverty. The purchase of any kind of insurance, when insurance or if insurance, should always be made with the help of an expert licensed professional. Insurance premiums do not cause poverty, but they just might prevent it. Offering you wisdom on wealth, I'm Byron Moore.